Have you ever stopped to wonder why some people seem to accumulate wealth effortlessly while others struggle to make ends meet? The answer lies not just in how much money they earn, but in how they choose to spend it. In this video, we're diving deep into the concept popularized by Robert Kiyosaki in his book Rich Dad Poor Dad, where he highlights a fundamental difference in mindset between the rich and the poor. It boils down to one crucial distinction: rich people buy assets, while poor people buy liabilities. By the end of this video, you'll not only understand the difference but also discover practical choices you can make at any income level to build your wealth. Segment 1. Defining assets and liabilities. What are assets? Let's start by defining what we mean by assets. Assets are items of value that can generate income or appreciate over time. Think of things like real estate, stocks, mutual funds, or even a business. These investments work for you, putting money in your pocket instead of taking it out. What are liabilities? Now, on the flip side, we have liabilities. Liabilities are things that take money out of your pocket, like a new car, excessive credit card debt, or a mortgage on a luxury home. They don't generate income, instead, they incur expenses. Segment 2. Real-life examples of asset purchases. Example 1. Real estate investments. Imagine you have a choice between buying a brand new car for $30,000 or investing that same amount in a rental property. The car will depreciate over time and may cost you additional expenses for insurance, maintenance, and fuel. However, if you invest in a rental property, you can generate monthly rental income. That $30,000 could turn into a consistent revenue stream, and the property itself could appreciate over the years. Example 2. Stock market investments. Now let's look at stocks. Instead of spending $1,000 on the latest smartphone, a liability that will lose value as soon as you leave the store, consider investing that money in a diversified portfolio of stocks. Over time, those stocks have the potential to grow, and you'll be earning dividends to reinvest or spend. Example 3. Starting a business. Even if you're starting at a lower income level, you can still choose to invest in a small side business instead of blowing your paycheck on a vacation. For instance, starting an online business selling crafts or freelance writing can create a new income stream. The initial investment can be small, but the potential returns can be significant. Segment 3. The mindset shift. Understanding the scarcity mentality versus abundance mentality. Here's where the difference in mindset comes into play. Poor people often operate from a scarcity mentality, focusing on immediate gratification, buying that new car or the latest gadget. They think, "I deserve this." But that mentality only perpetuates a cycle of dependence on consumption. On the other hand, rich people adopt an abundance mentality. They focus on long-term wealth-building strategies. When they see an opportunity, they ask themselves how it fits into their financial goals. Quote, as Kiyosaki states, "The rich invest their money and spend what is left. The poor spend their money and invest what is left." This mindset shift is crucial for anyone looking to build wealth. Segment 4. Making practical choices at any income level. Example 1. Education as an asset. Investing in education is one of the most valuable assets you can acquire. Instead of spending money on a fancy dinner or a weekend getaway, consider enrolling in a course that enhances your skills or career prospects. Whether it's a cooking class or a certification in your field, that knowledge becomes an asset that can increase your earning potential. Example 2. Building an emergency fund. While it might not seem glamorous, having an emergency fund is another way to think like the rich. Instead of spending your extra cash on clothing or dining out, save it. An emergency fund provides security and prevents you from going into debt during unexpected expenses. Example 3. Networking as an asset. Think about your social capital. Instead of spending weekends partying or shopping, invest your time in networking. Attend industry-related events or join organizations that align with your career. Building connections is an asset that can open doors to new opportunities and partnerships. Segment 5. The ripple effect of buying assets. How buying assets impacts your life. When you consciously decide to buy assets, it creates a ripple effect in your life. You begin to focus on income-generating activities, expand your financial knowledge, and develop a more secure future. The power of compound growth. For instance, when you invest in stocks or real estate, you benefit from compound growth. Your money works for you, and over time, the returns can be significant. This contrasts sharply with liabilities, where you're always playing catch-up. Watch this video to understand compound growth. Segment 6. Call to action. So, as we wrap up today's discussion, remember that the choices you make with your money today can have a profound impact on your financial future. Whether you're earning a little or a lot, you have the power to invest in assets that will contribute to your wealth rather than draining it away. Final thought. As Kiyosaki reminds us, it's not how much money you make, it's how much money you keep, and how hard it works for you. So, take a moment to evaluate your spending habits and think about how you can start buying assets today. If you found this video valuable, please give it a thumbs up, share it with your friends, and subscribe for more content on building wealth and financial literacy. Remember, the path to wealth starts with the choices you make today.